I hope it finds you well. You had a good trading week last week. Today I want to concentrate on the technical topic of divergence, purely because this is something that has been questioned quite a lot by many of you that have watched the previous video blogs, and it's probably something that I've only gone through briefly. So what I want to do today is address it in a bit more detail so you can understand just how powerful it is. It's something that I've used for the last 4 years, and it's probably the most common technical tool that I use, and one that's helped me generate a substantial amount of pips in the time that I've been using it. So let's go through it in a little bit more detail so you understand what it is, how to apply it, and then you can go away and do a little bit of back testing and just see how powerful it is, and then start to incorporate it with your other technical factors going forward to try and utilize it in the same powerful way that I've done so over the last 3 or 4 years. So there are two types of divergence, and we're going to go through the standard divergence. We're going to leave hidden divergence for another day. We're just going to go through standard divergence. The two types are bullish divergence, which we'll look at in a second, and bearish divergence. And the great thing about divergence is that it's a forward-looking indicator. Now, as a trader, I'll always say that we only make money when we speculate on the direction of a market before the market moves in that direction. So any forward-looking indicators that we can find are absolutely fantastic. It's all well and good looking at indicators in the past, but if they don't actually provide use in real time, then they're absolutely no good to us. So the great thing about divergence is it's actually a forward-looking indicator. I'm sure you've seen some of the powerful moves that we've been looking at over the last few weeks and months, where divergence has presented itself in advance of the market moving, and if we can use that to our advantage, then we know that that helps us make money when we predict and preempt the market move before it happens. So very powerful stuff. So the two types, the first type is bullish divergence. This is where the divergence is giving us an indication that the market wants to head up strongly from a strong move down. So divergence is utilized in order to take advantage of a reversal in a market move. So if the market's been moving down strongly, bullish divergence is there to help us spot when a market is likely to reverse and move up strongly. So bullish divergence is the first side of divergence, and then second side is the bearish divergence, which is just the complete opposite, where the market has been moving up strongly. We then see bearish divergence, which is a forward-looking indicator that the market is likely to reverse and head down strongly. Now, one of the best markets for divergence over the last few months has been the FTSE 100, and that's what you're seeing on the screen right now. This is the daily chart, and the divergence has just been absolutely fantastic, very, very clear, and giving us those forward-looking clues that the market is about to turn and head strongly in the opposite direction, so we can take advantage of it. Now you can see the channel that it's been in, the resistance level at the top just here, and the support level at the bottom. Now I won't ever trade divergence blindly just on its own. I will always use it in conjunction with other factors, but today we're just going to look at the divergence in its singular form. When you tie it in with other technical factors, then you are getting a very, very powerful team for trading. So those other factors are things like Fibonacci extensions, price action, horizontals, trend lines, moving averages, all those factors that all come together that suggest the market is going to turn from one direction to another, and then we put our hard-earned cash on the direction we believe it's going to move in. So let's have a look at the examples. So bullish divergence first. We know bullish divergence is giving us a clue that the market is ready to turn from a move down to a move up. So it was this period here at the end of November, and this was the trade that we took, and this was the one that we were looking at in previous blogs, but let's go through it again in a bit more detail. So the market has moved down strongly, so it's come down into support. So we're thinking, could it potentially bounce here? Well, we want a bit more evidence, and this is where the bullish divergence can come in really, really useful, because it gives us that further confidence that the market is going to reverse sharply from a move down. So it's come into a support level. However, can we find more evidence? So the divergence is as follows. So the bullish divergence. So we see this big move down from here to here before it stops and then has a very small but noticeable reaction to the upside. So a phase two, a very small phase two. So it's helped us visualize this low here. So it's formed a low. The market then reacts and has another strong move into support to create a brand new low. So the market, in terms of the price action, is putting in lower lows. Absolutely normal for a downtrend. However, if we look at our stochastic, and I'm just concentrating on the blue line here, ignore the red. If we compare like for like, so come down from this first low, and then come down from this new low, we can see that actually the blue has put in a higher low. So the price action has put in a new low, but this hasn't been matched by the oscillator, the stochastic. So that is what we call bullish divergence, where there is a discrepancy between the two. The price has put in a new low, but the stochastic hasn't done the same thing, and that's giving us a clue and a confidence that the market should reverse from this particular point. This is where, on top of the bullish divergence, we look for other factors. So we look for the bullish price action, we look for the support level, we look for the Fibonacci extension. All that grouping of technical clues give us the confidence that the market is likely to head up. But for me, one of the strongest clues is the bullish divergence, because it's saying actually price has gone down quite strongly, but the oscillator, the stochastic, hasn't done the same thing. Something's not quite right here. And then as we see from the bounce, the market moves up very, very aggressively, in line with the Santa Claus rally. So you can look back at the previous blogs. We did preempt this turning point, but the stochastic divergence was one of the key clues and the key factors that gave us that confidence that the market was going to turn. And as we can see, the market had a significant push to the upside. And that's the great thing. Another thing I really value with divergence, when it comes to fruition, more often than not, the reactions are very, very significant. So you're not looking at 2 to 1s, you're looking at 3, 4, 5 to 1s. So it's absolutely brilliant when you're able to get into the turning point from a big strong move down to the big turning point and the big strong move up, because that often, not always, but often leads to a very healthy reward to risk. And then that came into the opposite scenario. So we've gone from bullish divergence now to where we saw the opposite, bearish divergence. And this doesn't happen all the time. This is just a really nice example of one where bullish divergence created an opportunity and then ran straight into bearish divergence and created another opportunity. So as we see here, we had that strong reaction where it stopped heading up at this point here before it then had another mild retracement. So a phase 2. Before then it had another strong phase 1. So if we look at this point here where it topped out, that is what we call the high, before it pulls back and then runs up to form a higher high. So we now see the market has put in higher highs. So from this peak here to this peak here, we've created a brand new high. Fantastic, very bullish. However, notice if we look at like for like on the stochastic, we've actually got a lower high. Very clear, very obvious. If you're really struggling to see if it's diverging, it's clearly not there. So move on and find another opportunity. Clarity on both the cyclicity on price and the peaks and the troughs on the stochastic are absolutely essential. You need to be able to see them clearly. If they're not there, move on to another opportunity. So with this here, we top out on the price action into resistance with lovely high test bars, and we'd expect the market to pull back and have another strong move up. However, because of the bearish divergence here, we actually expect not a retracement, we actually expect a full reversal. And when we expect a full reversal, we want to take advantage of that, because like we saw with the turning point here with the bullish divergence, we got a good 4%. And on the way back down, by entering just on the breaks of the low of these high test bars, that was almost a 5 or 6% on the way down. So more than worth your while taking divergence trades. Now you are going, point to note, you are going against the trend. So that does mean that you aren't going to succeed on every single trade, because you're going and swimming against the tide. However, because of the significant reversals that you get on those trades that do work out, it's more than worth your while. No technical factor will work 100% of the time. However, if I can get it to work 50% of the time, but those 5 times out of 10 that it works give me 3 or 4%, the maths works very, very well. So don't expect this to be the holy grail, because it's absolutely not, but it's the closest thing to it in terms of getting a significant return on your investment when the trade does react like this. So as we see a couple of trades that we looked at in previous blogs, so it's not like we're looking back at perfect examples. These were trades that we were taking back in December, and also at the end of 2014 into early January, both this buy position to the upside and the sell position to the downside. Bullish divergence here with a lovely clear divergence there, and bearish divergence up here, again with the clear divergence on the stochastic indicator. Now, people often ask me, what's your preference? Because there are different types of oscillator to give us this divergence. There's the MACD, there's the RSI, there's the stochastic. Personally, I've used the RSI and stochastic, but I've used the stochastic from a teaching perspective because just by working with my delegates and my clients, it just seems to be easier on the eye to see the stochastic peaks and troughs. And if that helps people identify it easier, then that's the reason why I'm using it. But I do often use the RSI as well, but the stochastic is absolutely fine. The settings that I use are the 833. So if you need to put this into your eSignal or your MetaTrader, it's the 833 are the settings for the stochastic. And the RSI is the 6 and the close. So the RSI is the 6 and the close. So really, really nice example. We did get another divergence off support recently in March where price came back down here, formed a bottom, came back up, and then pushed back down to double bottom, broke the low. So this area here was lower than the previous low. However, look at like for like, a clear higher low, and the market has started to head off. Not really done much yet, but another really nice example of divergence there, where the market has come into a lovely level of support. And I think this is the critical factor, is you can't just trade divergence on its own right. You combine it with your other technical factors to give you confidence that the market is ready to turn from a particular point. And if you can get in efficiently at these key turning points, we can see the reward is absolutely fantastic. And this is just one asset class. This is the FTSE 100. Stochastic divergence will happen on every single asset class. So go away, spend some time looking back through your charts and looking for these divergences. And once you've found the divergences, then add some other technical factors in. Can you find any horizontal resistance levels? Can you see any price action reversal bars like we saw up here, these lovely high test bars off resistance to give us that added confidence the market wanted to head down? Fibonacci extensions. Is the market overextended in conjunction with the divergence? Is it hitting its head against the moving average? Whatever that may be, look for some other factors, and then most importantly, see what happens after the divergence has presented itself. And I'm sure you'll be surprised. Yes, you will find some occasions where the divergence presents itself and the market keeps on going and would have stopped you out. But look at the ones that really do work out, and look at the 2, 3, 4% trades, and you can see that financially at the end of a period of time, 6, 12 months, your edge is going to see itself through to profitability. And that's the critical element. So let's have a quick look at another asset class. One that's happened quite recently is on gold. Gold again, I want to concentrate on trades that we actually looked at before the moves happened, because even though we are looking back, if you go back through previous vlogs, you will see that we did identify these key turning points. So gold was some lovely bullish divergence there, not as clear as the previous examples that we saw on the FTSE 100, but still divergence nonetheless. So this market came into a lovely support level, had a big push down to form a low, retraced in its phase 2, and then had another push down to double bottom, failed to close below, but notice that this bar here does break the previous low. However, if we do like for like, we do not get a new low on the stochastic. Classic example of bullish divergence in conjunction with a double bottom, in conjunction with an ABCD pattern, in conjunction with a support level, a horizontal support. And again, if you can't remember the factors as to why we took this, go back through previous blogs and you'll see this, how we identified it well in advance. And then as we can see, the market didn't just have a little bit of a reversal, had a complete change in trend and went almost 1,000 points in our favor. So another great example of how powerful divergences can be from a reward to risk perspective. Again, doesn't mean it's going to work every single time, but on the times that it works well, it works tremendously well. And then gold, we got the bearish divergence on this bar here. So we had this big, huge bearish outside bar off the 786 retracement, but we also got lovely bearish divergence. We actually got double divergence. So we got divergence here, and we may have been stopped out on this particular occasion. If we'd have tried selling here, the reversal would have been stopped out. However, it carries on to diverge from here to here. We formed a lower high, but it's actually formed a much higher high on the price action. Huge bearish divergence, lovely significant bearish outside bar, and this market has started to run and is at the 2% mark already. So it has covered the losing trade we may have taken. Not saying we would have taken that, but had we taken it, this is an example of how divergence on this occasion doesn't quite work out. But this significant turning point here then gives us a couple of percent and potentially can go a little bit lower. Now, in terms of the gold trade that we're watching, this level around the 1268 area is quite significant. We talked about it last week, but I'm watching it even more now because we've had such a strong push down. I'm watching it even more because we're not too far away. We've got this lovely horizontal here, beautiful resistance, support, support, resistance, resistance, finally breaks. So potentially is now going to play as support. It also corresponds with the 618 retracement, the Fibonacci retracement. Again, Fibonacci is something we'll cover in a separate topic. I don't want to do everything all at once. We're just concentrating on divergence here. But it's broken and it's heading all the way back down. What I would like it to do is actually to pop up for a few days, potentially back to the 200 moving average, and then to come back down into this zone. Because if it does that, it will then give us the ability to see if there's any divergence. Because if it pops up and heads back down, we'll then create a new low. And if we haven't matched that on the stochastic, that will give us the bullish divergence that will add further credibility to our trade. We've already got a horizontal level of support, which is very significant because it's had many reactions in the past, almost 4 or 5 reactions in the past. It also corresponds with the 618 Fibonacci retracement, and we've come all the way back down into oversold territory on the stochastic. So ideally, I would really like a little bit of a pushback higher, another strong move down, to give us the ability to then add bullish divergence and potentially a Fibonacci extension to this trade to give us an almighty technical case for taking this trade long and potentially then having it go back up to its previous high, which offers us a nice healthy reward if we get an opportunity down at the 1268 level. Target really is back up to the 1400 level, which is a more than healthy reward to risk on that trade. So gold is one I'm watching carefully, monitoring over the next week or so for this zone just down here, the 1262 to the 1268 area. And again, remember, price action is all important as well, so it'll be interesting to watch that over the next week or two. But in terms of divergences, we can see here bullish divergence, another great example of how we made some nice profits on the way up. And I personally didn't take the move on the way down. I sadly missed the move, but would have been another nice example of bearish divergence just up here to add to the profitability of the buy trade. So hope that's helped to clarify divergence and answers many of the questions that you've been asking me. What I urge you to do is go back through your charts and to look for divergences, both bullish and bearish. This will not only help you from a technical perspective, getting to grips with it, but also from a belief perspective when you start seeing some of those very powerful moves off the back of stochastic divergence. So very, very powerful clue, but go and become brilliant at it, because I can assure you it will help wonders in your profitability as a trader, and also helps you massively with your timing and your confidence to take a trade. So I'll wrap up there. I wish you well for the week ahead. There's quite a lot of significant news out next week, so tread with caution.